There we go. So now we're recording. So class 4 knowledge check. Question number 1. What is the ledger? And what's the other name for the general ledger? What do you think? What is the general ledger? And what is another name for the general ledger? Okay. All right, we'll give you the ledger is there we go. Okay, good, Marianne. It's the book of final entry, so that's the other name for it. And it combines essentially all the transactions that have happened that are posted to the ledger. From the journal, and we post those transactions into the respective account that it affects. Once we've posted all of the all of the transactions found in the journal to the ledger and to ledger accounts, we can then take a balance of each account and then post those balances to the trial balance to make sure it balances. Okay, really good. Question number 2, what rules do the ledger and the journal have in common? What rules, or what rule does the general ledger and the general journal have in common? That's one specific rule that we have to follow in order to post to the ledger and to the journal. Yeah, exactly. Debits, it's your debit and credit rules, right? You do N, which means double entry accounting. Okay, so to affect an asset, you must also affect either a liability, equity, or a combination of both. Absolutely, right? And to Vanessa's point, we have to be consistent with our method. We have to follow those debit and credit rules consistently between both the ledger and the journal, right? Very good. All right. Question number 3. In what order is the chart of accounts presented in? So your chart of accounts is a list of all the accounts that you have within your accounting system, but those accounts are listed in a specific order according to account type. So what account types, in what order are those account types listed? And I'll give you a hint here. It starts with balance sheet accounts, followed by income statement accounts. Mariam, pretty close, pretty close. We typically list them in terms of the assets first, so assets, then followed by liability accounts, absolutely, followed by equity accounts, and then these 3 counts are found on the balance sheet and in that order on your balance sheet. Okay. The remaining 2 accounts that you find, or the next two accounts that you would find in this order are your revenue accounts and then your expense accounts, which are found on the income statement and in that order. Because revenues come first, followed by your expenses, and then you have profit at the bottom. Right. Good job, everybody. All right. Question number 4. After posting to the ledger, what is the next step in the accounting cycle? After posting to the general ledger, and you're taking your balances and stuff, what is the next step in the accounting cycle? So we've journalized all our business transactions, okay, and then we've posted them all to the ledger. We've taken the balance of each account on our general ledger. Where do we transfer those balances to? And, well, Vanessa's technically right. As the last comment here, you transfer those balances to the trial balance, and that is the next step in the accounting cycle. It's taking a trial balance. So you do the first step is you do a transactional analysis to make sure you have business transactions. You then post those to the general journal. You post those individual changes to the general ledger accounts. You take a balance of each account, and then you post those, or you transfer those balances to the trial balance to make sure that your debits and credits balance. Okay. And then question number 5, which I pretty much just answered, but just in case somebody missed it, what must balance on the trial balance? What must balance on the trial balance? Exactly, Vanessa. Your debits must always equal your credits. And if you follow the rules of debits and credits, the debits on your trial balance will equal the credits on your trial balance. Okay, very good. And then question number 6, why should a trial balance balance? It is very satisfying when they balance, and it's also less time consuming when they balance because you don't have to go find the errors. If not, there's a mistake. Absolutely. Yeah, yeah. So why should a trial balance balance? And it was already, this was mentioned by Paul already. Exactly, Marianne. To make sure if it balances, sorry, if our trial balance balances, it balances because we follow the rules of debits and credits, but also double entry accounting, or the double entry method, which means that, and it follows that our assets must always equal our liabilities plus our equity. Oh, that's an this is an E, not a P. And that our sales are equal to our expenses plus our profit. Okay, or our profit equals our expenses, sales minus our expenses. But typically speaking, double entry accounting, absolutely. What's one technique that we can find? What's one technique that we can use to find an error on our trial balance if it doesn't balance? Okay. Well, there's a couple of ways. The most easy way I find is that, let's say your debits, first of all, do not equal your credits. Exactly. Try to find the difference in one of the T accounts or the T charts. Absolutely. Um, and one way you can find that difference. Okay, so right now, if your trial balance doesn't balance, your debits do not equal your credits. Okay, so let's say your debits are higher than your credits. Okay, what you can do in that case is take your debits, subtract your credits, and there's going to be a difference, right? You can go find or try and find that difference in the either in the ledger or in the journal. It's the mistake is going to be typically found in your ledger. So by finding that amount, you go to your ledger, you hit Control Find, you type in the number, and if it finds that number, that's probably where your error is stemming from. So you have to kind of look at how that has been posted to the ledger, or if it's been how that's been posted to the trial balance. Maybe it's done improperly, or it was omitted completely. Maybe the balance in the ledger is incorrect, or yeah, that's the only two things. Finding one mistake is pretty easy. Okay, if you've only made one mistake in journaling, ledgering, and then posting to the trial balance, you should be able to find your mistake pretty quick. But as the number of mistakes increase, the more difficult it's going to be to find your mistake. Okay, for example, it's a lot easier to find a mistake worth $51 because you're just going to look for $51. But if that's one mistake, you're looking for the number 51, right, or a difference of 51. However, if you've made two mistakes, one for $48 and then another for $3, that still equals 51, but it's actually two compounded mistakes. So it's going to be hard to find and separate those two, right? So the best way to be going about journaling, ledgering, and posting to a trial balance is taking your time and being methodical about it. Okay, so you do your journal transactions first. Make sure everything is good there. Make sure your debits equal your credits. Okay, and then use your journal as a list when you're posting to your ledger. Okay, so you do the first account of the first transaction first, the second account of the first transaction second, and then so on and so forth, all the way down your journal. And then once you've completed all of that, you can take your balances and do it all in one step. And then once you have all your balances in your general ledger, move them all to the trial balance in order that they appear on your general ledger. Okay, if you follow that kind of method and kind of like a step-by-step progression, you're going to eliminate a lot of mistakes. Where I find some students do tend to make some mistakes is if they're bouncing between steps, right? They journal, they put a transaction into the journal, and then they move it immediately to the ledger, and then they move that immediately to the trial balance. That's just going to lead to just a swamp of mess. Okay, so try to follow that step-by-step progression that we kind of did on Thursday. Okay, and it will definitely eliminate making some of those small mistakes, and those small mistakes will definitely make your trial balance not balance. Okay. Cool. So does anybody have anything I can help with either the class 4 knowledge check or any of the knowledge check that we've gone through before? So I'll move this up, see if I can go back to page 1 here. There we go. So we have class 1 and 2, class 3 knowledge checks. Does anybody have any questions about those? Yeah, absolutely, Danny. Last question. The next step in the accounting cycle after we complete the trial balance for the first time. Oh, sorry, the last question. I totally missed it. Sorry. Very close, Vanessa, very close. After we've completed our trial balance for the first time, and you might not know the answer to this because it's kind of what we're going over today, is we have to do some adjusting entries and an adjusted trial balance. Okay. Or you can just sum it up by saying adjusting entries and, well, yeah, the adjusted trial balance. And adjusting entries, they will take some, you have to do calculations in order to know by how much we're going to adjust some accounts. And generally speaking, I know we're not getting into it just yet, but we need to do adjusting entries because sometimes if we do nothing, then the balances of certain accounts are incorrect technically. And we have to do adjusting entries so that the account balances reflect the true balance of the account. Okay. And in a lot of cases, adjusting entries will not have a source document. And while they are a transaction, well, they're not technically a business transaction, but we still need to adjust these accounts so that the account balance is reflective of its true balance. For example, depreciation. We know that assets or pieces of equipment lose value over time. We need to adjust that value on a monthly basis so that the balance of our equipment is reflective of its true value. Because as we had mentioned, over time, the value of an asset goes down. Okay, so we have to show in our accounting records and in our financial statements that the value of that asset is going down, but there's no transaction source document to show that it is. We have to adjust it manually. Okay, but we'll get much more into that as the class progresses. Okay, so before we continue with a bit of an exercise on posting some journal transactions again. Does anybody have any questions about any of the previous knowledge checks? Is there anything maybe I can go through or clarify? No? Okay. So no questions, I'm assuming here. Put a thumbs up in the chat if you're ready to continue to the next exercise. Okay, I'm gonna got some thumbs up. Okay. Some question regarding worksheet. All right, Sue Young, could you clarify your question a little bit more? And while you do that, I'm just going to bring up. Ooh. Okay. Well, both of those look to me like those are sales transactions. Okay. So there'd be two ways you could approach this. You could do in the journal, you could post those all individually, or you could add up. In this case, do we have to list the days separately? Not necessarily. I don't think you can do that in one transaction. The only thing that would be different is in your description of the transaction, it would be to record weekly sales. Okay, you could break that down per day if you like. There'd be nothing wrong with that. But I find the more steps I find when I have to do more than when this can be done in one step, you can also do this in like 6 or 7. It's much easier just to do it in one. So I think you get the the idea there. Awesome. So what do I suggest? Keep them together or do it separately? Well, what would I suggest? If it were me, and I've done this before, this assignment anyway, I would keep them together. Yeah, you can do them either way. For me, I like to keep things as simple and condensed as humanly possible. So I would probably so there's 2 points here. I would do 2 particular transactions or 2 posts. So I would just add up all the sales. So keep them together, because if you do them separately, one mistake will lead to like 5 others. And, well, Vanessa, if you kept them separate, that's totally cool. It's going to yield the exact same result. There's nothing wrong with doing it separately. Nothing at all. All right. So I'm going to stop sharing this. So what I'm just going to put up a different file here. Right there. There we go. Question, what would be the proper date for that then? January 7th? Yes. But if you're doing them individually or separately, then you just put the date on that that it happened. Okay. Oh, no problem, Vanessa. So what I'd like everyone to do right now, I'd like you to go on to Blackboard under this class's this class's materials and open up I'm just trying to find what it's called here, the Adjusting Entries and Trial Balance Worksheet. Okay, so this is the worksheet we're going to be working with all class. So everyone open that up. Okay, put a thumbs up in the chat when you've got it open and ready to go. Kinsada, just go to the this week's learning materials and open up the file called Adjusting Entries and Trial Balance Worksheet. Wait for a couple more thumbs up. We got 4, 5, 6. Got 6. Need more thumbs. Kinsada, Ryan, were you guys okay? Ryan's good. Kinsada, were you able to find it? I'm downloading it. Okay, awesome. Okay, so before we get into this, we're gonna be doing 2 things here. Okay, first we're gonna be working on some journal entries that you're going to post to the journal, and then move those changes to the ledger. Okay, and then retake your balance there, if you will. Okay. What's it going to do here? And then we're going to do some adjusting entries later on, but we need to make some. We need to post some journal transactions first. And before we do that, I just want everyone to remember some of the steps we need to keep in mind, or some of the things we need to think about when we're doing journaling or even adjusting entry posts. Okay, the first step is, think about the transaction and what accounts are being affected and by how much. Right? Typically, through the description of the transaction, it'll kind of tell you which accounts you should be looking at. Right? For example, if you purchased equipment on credit, it means this was obviously a purchase transaction. What did you purchase? You purchased equipment. And how did you pay? You didn't pay cash, which means it's affecting your accounts payable. Okay. You need to determine which accounts are increasing or decreasing. Okay. You got to think about, is this account going to go up or is it going down? If you're using something, typically it's going down. If you're gaining something, it's going up. And then based on that increasing or decreasing motions, you use the rules of debits and credits to decrease the accounts affected by that amount of money or the amount of the transaction. And then you post those amounts to the relative columns in the journal and then to the ledger. All right. So some of these journal entries that you're going to see here are going to be a little bit new, and they're going to affect some accounts that we may not have spoken about too much. Okay. So the first, and as I'm doing this, I would like you to post these. Actually, I'm going to bring up my worksheet as well here. Sorry, everybody, I'm just bringing it up. I'll follow along with everybody. I'm just opening it up. Okay, enable editing. Here we go. And before we start this, can everyone go to the trial balance tab on their worksheet? Okay, you see how it's filled in already for us. I want you to delete all of those balances in your trial balance. Okay, so just highlight them all and then delete, because those balances are going to change. All right. Go. Then once you've deleted all the balances in your trial balance, go back to your journal. Yes, the Excel worksheet, absolutely. So on the Excel worksheet, there should be 3 tabs. The general ledger, or sorry, the journal, general ledger, and then the trial balance. So once we've deleted all of the balances in our trial balance, go to our ledger. Okay, and in the ledger, we should see some of the transactions from last week. And we're gonna start to plug in these 4 that you see here on Collaborate. Okay. So the 4 transactions that we're going to be journalizing here. First one is you purchase 3 months of insurance on May 1st for $1,500 cash. Okay. The second is you purchased food inventory on credit for $1,000. Okay. The third is you purchased a $12,000 food truck with a useful life of 10 years with cash. Okay, so $12,000 cash. And you take out a bank loan for $10,000 on May 1st with an interest rate of 10% per year. Okay, so for these journal entries, we're going to assume that these were all done on May 1st. Okay, the date here really doesn't matter, just for journaling purposes. We're going to call this May 1st. All right, so for the first one, the first transaction, what do you think you would do here? How would you post this to your journal? Yes, we will be, Ryan. We'll be putting this into the journal, but what I'm going to do is I'm going to put the post, we're going to talk about the post to the journal first, and then I'll have you transfer it to your own journal. Okay. Does anybody have any ideas about how they journalize the first transaction here? You purchased 3 months of insurance on May 1st for $1,500 cash. Of the 4 transactions here, this is probably the most tricky because you may not have heard of this particular account. I think we brought it up, but we haven't used it just yet. Excuse me. Divided by 3, so young, very interesting. We will have to do that when we do an adjusting entry, but the journal entry here, what do we, we're purchasing 3 months worth of insurance, so insurance that's going to benefit us 3 months in the future. Okay, this is what we call a prepaid expense. I'm going to type it into the chat here. Prepaid expense. An expense that has being paid for and extends into the future. Okay, so that's a bit of a definition for you. So prepaid expense is an expense that has been paid for and extends into the future. So it's going to benefit our business into the future. Because it's going to benefit us in the future, because it's prepaid, it's of value. It's what we call, it is an asset, actually. Okay, so because our prepaid expense is an asset, we would debit our prepaid expenses. Actually, I'm going to type this. Okay, we would debit our prepaid expenses by $1,500. I'm just going to move. Oops. And then we would credit our cash by $1,500. Okay, so any services included in that criteria? Well, yeah, I guess insurance is kind of a service to some degree, right? But I don't know if other services would be included. Yes, Justin. Oh, okay. No, it's all good. You could call, it depends on your chart of account, Vanessa. Typically, we just call this prepaid expenses, or you could call it, if you had an account called prepaid insurance, you could call it prepaid insurance. Okay. So yeah, you debit your prepaid expenses and you credit cash. And the description here would be to record the prepayment of expenses or insurance. Insurance. There we go. This is documented at the bottom of the journal for chronological order. Yeah, so just continue, Paul, just continue where we left off, okay? Does that make sense, Paul? Awesome. Okay, so this is pretty much what the journal entry would look like. Okay, the date that we're going to put in, and the date really isn't relevant here. It's just for a good practice. Would have been May 1st. Okay, so we've got the date, the two accounts that it's being affected, our debits equal our credits, and we have a description. Okay, so everyone post that to your general journal right now. Should we change the reference number? Yeah, give it a reference number of picking up where we just left off. We left off at 5, so this journal's reference number would be 6. Okay. So are we adding this to the worksheet we've already done? Yes, so it's the worksheet that is on Blackboard, Mary Ellen, so you're just opening it up. It should contain much of the same information. We're just kind of picking up where we left off on the journal. Does that make sense? And here, maybe I'll show you my screen just so I can kind of show you what I want us to do here. Okay, so here's the worksheet. Okay, here's the worksheet. We've deleted. Oops. We've already deleted the balances in our trial balance, so we're just picking up where we left off here on the journal. Okay, so we're going to put in May 1st here, just for so we can put in a date. The debit entry here was prepaid expenses. Go. We'll give it a reference number of 6, and the debit, I believe, was $1,500. Okay, and then we were crediting cash by $1,500, and then we're just going to put to record the prepayment of insurance. There we go. So that one's done. Okay, so we're just adding to the list here. And then after we're gonna transfer those changes to the ledger, retake our balances, redo our trial balance, and then we're gonna do some adjusting entries. So I'm gonna stop sharing my screen here. There we go. I'm gonna put up that file again. There we go. Perfect. All right. So put a thumbs up in the chat once you've got that put into your journal. Perfect. Can you please go back again? I just got on. Yeah, sure, absolutely. So we were just recording that in the journal. I'm just gonna share my screen again. All right. So this is the entry that we were putting in. So your prepaid expenses, $1,500 on the debit, okay, and then cash for another $1,500. Your debits equal your credits. It's happened on May 1st. The reference number here, we're just continuing, so 6. And then the description I put in here was to record the prepayment of insurance. Okay. Go. Okay, so I'm going to stop sharing my screen here. There we go. Do we need to note somewhere that it is for 3 months? That's a good question. Yes, I would. And sorry that I missed that. So in the description, in the description of that journal transaction, you can specify 3 months. Absolutely. It's good to be specific when you're doing these transactions like this. So yes, absolutely, for 3 months. So let's come back to the chat here. Ryan, okay, good. Sorry, your computer crashed. So the next transaction that we're going to be working with here is you've purchased food inventory on credit for $1,000. Okay, so what do you think's happening here? What account would you debit? What account would you credit? What do you think? How would you put this into your journal? Purchased food inventory on credit for $1,000. Yeah, absolutely, Marianne. That's exactly what I'd do. So we'd put in the date here, so May 1st. There we go. We're going to put in our food inventory first, because that's what we're debiting it, and we'll give it a reference number of 7. And sorry, these lines don't necessarily line up because it's hard to do that. So we're going to be debiting our food inventory for $1,000. There we go. And we're going to credit our accounts payable by the same amount, or $1,000. Okay. So that's, can everyone see that down there? Yes, Catherine.
Hi there. Just wondering, which date is this for? Did you say the date?
Yes, May 1st.
May 1st. Thank you.
No problem. And can everyone see? I'm at the bottom of the page here. I'm kind of typing in what the journal entry would look like. Can anybody see that? It's in blue text. Do we have to list the date for every transaction, even if it's the same as the previous? Yes, I would, Mary Ellen, yes. Okay, so Nathan, Sue Young, we're just kind of continuing from the previous reference numbers, right? So if you put in 2, it would be the same as, you'd have a duplicate reference number. So we're just kind of continuing. Nick, it's near the bottom of the page here on Collaborate. Can you see it now, Nick? Yeah, Justin, that would work. You would either you can either zoom out or scroll down. A good call. Okay, maybe it'll be better if I just should be accounts payable. Yes, it should be accounts payable. So I'm just going to share my screen here. I'm going to put that in quickly. There we go. So again, May 1st. Okay, May 1st. Oops. May 1. What did we do here? Oh yes, food inventory. Inventory. Spelled inventory wrong. Inventory. Perfect. Reference number 7, just because we're continuing from the previous. We bought $1,000 worth of food inventory, and it was on accounts payable. It was on credit, I should say. Bigger. 1,000. Another description I'm going to put in here is to record the purchase of food inventory on credit. There we go. Okay, so we've got the date, we've got the two accounts, debits equal our credits, we've got a reference number that's in sequence, and we've got a fairly detailed description. Okay, so I'm going to stop sharing. Come back here, share file. There we go. Chat. Let me leave and come back again. Okay. Can I see the reference number? Can I see reference number 1 for a second? Yes. Your reference number 1 should already be completed, Katsada. Number 7. Yeah, sure. How do we say how it's recorded? How do you mean? You mean the description of the transaction, Ryan? You're just giving a description of what happened on the transaction. So for in this case, we purchased food inventory on credit, right? Your description could be as simple as to record the purchase of food inventory on credit. So it's almost restating the transaction itself, except you have to record. To record the purchase of food inventory on credit, absolutely. Katsada, I'm going to. Oh no problem. It's all good. Katsada, I'm going to share my screen just one more time so you can see it. There we go. So here's my entry for reference number 7. Okay. There we go. Stop sharing here. Go. Come back. Files. Practice. Share. Lots of moving parts. No problem. Oh, awesome, Ryan. And no problem. All right, so the third here, you purchased a food truck for $12,000 cash. Okay, it has a useful life of 10 years, but don't worry about that piece of information just yet. Okay, what would you do here? How would you journalize this? Okay, Paul, not just yet. We will have to get into depreciation, but first we have to record the purchase of the truck first. So how would you record this purchase on your journal? Equipment debit, absolutely. Same as we did on equipment, yes. Okay, but how? Well, give me the deets. Credit cash, absolutely. So I'm going to share my whiteboard here so everybody can see. Okay, so we would put May 1. Okay, you would debit equipment. and I believe it was 12,000. Okay, so you're debiting equipment for 12,000, and because it says we paid cash, we would credit cash by another 12,000. Okay, can't put another zero in here. There we go. And the reference number for this would be 8. So everybody put this into your journal now, okay? And then put a thumbs up when you've completed this. Putting it in mine as well, so we're following along with you. And the description I'd put in here is to record the purchase of a food truck. Perfect. Okay, so we've got some thumbs, I'm hoping. Many thumbs, this is good. We're doing a good job. So, the last one, got more thumbs, this is good. Oops, share. Come on, Blackboard. The last of the 4 here is you've taken a bank loan. Even more thumbs, good, good. So you take out a bank loan for $10,000 on May 1st, okay, and it has an interest rate. And Vanessa, correct. We shouldn't be worried about the 10 years just yet. Not just yet. We will though in maybe half an hour. So you've taken out a bank loan for $10,000. Okay, and it has an interest rate of 10% per year. Okay, don't worry about that 10% just yet. Okay, we will have to use that later, but not quite just yet. So focusing on the bank loan itself, we have to record that particular point of the transaction. What would you do here? How would you record this in your journal? Mary Ellen's, yeah, pretty much on track. I'm going to share my whiteboard here. So again, May 1, okay, we would debit cash by $10,000. I think that's how much it was. And we would credit our bank loan by another 10,000, right? And then the description here, sorry, the reference number I believe would be 9. Sorry, it's kind of hard for me to include all this information. My screen is super tiny. And then the description would be to record a new bank loan. Okay. So everybody put that into your journal and then put a thumbs up in the chat when you completed that. We'll do the same. Okay, so again, May 1. There we go. Cash. Reference number 9, $10,000. I want $10,000. $10,000 would be nice. Those of you who played the Lotto Max were at, I think, what, 55 million? 60 million tonight? But it's a lot of money. Bank loan. And then to record new bank loan. Here we go. Awesome. We got some thumbs. 1 second. Take your time, Ryan. Would the account be bank loan or loans payable? It would be bank loan. Okay. The loans payable will come later. Absolutely. Good question. Okay. No problem at all. Okay. So, what's the other description for the last one? What do you think? It'd be to, I guess, up here on the screen, to record a new bank loan, or the issuance or the issue of a new bank loan. Up to you. So now we've just completed more transactions, right? So 4 new ones. No, the other one on the top, I mean. On top of where? On top of the last one? Or what's the reference number of the transaction you're referring to? Number 9. Yeah, to record a new bank loan. That was number 9. Awesome. So yeah, so now we've recorded these in our journal. Good job. Second step of the accounting cycle. Done. Check. This is good. And good practice, everybody. Good job. What's the next step here? Okay, so now we've posted more transactions to the journal. We have to transfer the changes for these four transactions where? What do we have to do with this information now? Yeah, we've got to transfer that information to the ledger. Okay, so what I'm going to do now is I'm going to share my screen and I'm going to post. Actually, you know what? Maybe we'll take a bit of a break here, okay? Because we've been going for an hour. I mean, we'll take a quick 15-minute break and we'll pick it up, okay? So I'm just gonna do this. Let's take a quick break. Take a quick break, and we'll be back. We'll be back at at 2:14. All right, so everybody grab a coffee, grab a glass of water, a snack, and I'll see you back here at 2:14, and we'll start to transfer that information from the journal to the general ledger. Okay, so everybody have a good break, and I'll see you in a bit. All right, welcome back, everybody. I hope everyone had a good break. Get maybe a snack or a glass of water. Right. So before the break, we journalized 4 business transactions. Okay. We've posted to the journal. Now we want to transfer that information to the ledger. So what I'm going to do is I'm going to share my screen. Okay, and then I'm going to go through and do post to the. I'm going to post to the ledger, but I'm going to do it. I'm going to do one transaction at a time, and then come back to see if you have any questions. Okay. Before we do that, okay, everybody go. I'm going to share my screen now, and I want everyone to go to their ledger. Okay, and in the balance column, I want you to delete all of the balances, all of the existing balances for the accounts, and I'll show you how. Just give me 30 seconds. Share my screen. There we go. Share. There we go. So we're going to be posting to the ledger here, and we're going to be doing that for transactions 6 through 9. But before we do that, everyone go to your ledger, and then you see how each account has a balance. We're just going to delete that balance because we're going to be making some changes to the accounts. So I'm just going through each of my accounts, and I'm deleting the balance in each. Okay, go. Right. Very good. Okay. Good. So I've deleted all the balances in each account. And now I'm going to start to post these transactions to the ledger. And to do that, or to start doing that, I'm going to start with transaction number 6 here, with the reference number 6. But before I do that, if you are putting in a number and it's coming up as a date when you want it to be a whole number, you might have to reformat your cell. Okay, so right here, you would go to the cell you want to reformat, and then under the Home tab, there's a formatting tabs on the number ribbon. You just want to reformat it as either general or as a number, but I would say just put it as a general cell. Okay, and once you do that, it should change whatever you're putting in there to a whole number. Okay, so I'm going to post to the ledger for what is it? Journal transaction number 6. I'm going to do that, and then I'm going to come back to the chat to see if you have any questions. And please follow along with me while I'm doing this so that we can continue with the exercise later. Okay. So we want to post $1,500 to the debit side of our prepaid expenses, and this is 6. Okay. So I go to the general ledger. I find my prepaid expenses. There we go. Post it here. So it was on May 1. The description here was to record 3 months of prepaid expenses. So make this a bit bigger. Reference number was 6, and we debited it by $1,500. There we go. And I'm going to go back to the journal to see the next line when we paid it for cash. So I'm going to go to the ledger again, go all the way up to cash. Cash count. This was May 1. And the description here was to record the purchase, to record 3 months of prepaid insurance. Okay. Journal transaction was 6, and we are going to credit it by $1,500. There we go. So now we've ledgered, posted to the ledger for these 2 accounts, prepaid expenses and cash. So we've done that transaction. So I'm gonna stop sharing my screen, and I'm gonna come back to the chat to see if you have any questions. Does anybody have any questions about that one? Oh, no problem, Vanessa. And then put a thumbs up in the chat once you've posted that journal transaction to your ledger. Yeah, right. I can repeat what I did. Is I went to my ledger and I posted $1,500 to the credit side of my cash account, and then I debited my prepaid expense account by $1,500 on my ledger. I'm just transferring the information. Can you see the cash entry? Yes, of course. So I'll share my screen again. There we go. The cash entry on the ledger was May 1st. The description was to record 3 months of prepaid insurance. The reference number was 6, and I credited it by $1,500. Okay. So I'm going to stop sharing here and see if that helps. Awesome. All right, so let's do the next transaction. I'll share my screen. There we go. Back to the journal here. We're looking at transaction number 7. Okay, so we purchased some food inventory on credit. Okay, transaction number 7, and it was for $1,000. So we're going to debit food inventory account by $1,000 and our accounts payable by $1,000. So I'm going to go to my general ledger. I'm going to find my food inventory, which is right here. I'm going to put in May 1. And the purchase here was, or so the description was to record the purchase of food inventory. Reference number here was 7, I believe, and we purchased $1,000 worth of food inventory. The second account that was affected in this particular transaction was your accounts payable, which I've got to find here. Where is it? Maybe it's up here. I might have to put it in. Yeah, I've got to put it in. So when you're doing this one, come down to the next account under interest payable, and in the account name, type in accounts payable. There we go. Sorry, I thought I had done that already. So we're just putting in the account name, accounts payable, into the blank account under interest payable on your ledger. So let's put this into our ledger. We've got May 1. Description was to record the purchase of food inventory. There we go. I believe this was reference number 7. And we credited it by $1,000. There we go. And the credit of our transaction is now posted. So we go back to our journal, and we have completely posted transaction number 7 to our ledger. All right, so I'm going to stop sharing here and see if you have any questions. So, completed. Nice, Vanessa. All right, everybody else, throw a thumbs up in the chat if you were able to follow along and post that to your ledger. Very good, very good. Okay. Good. Okay. So yeah, now we're going to continue with the next transaction. Share my application again, screen. There we go. So transaction number 8, which was the purchase of a food truck or some equipment here for $12,000. We debited equipment by $12,000 and we credited cash by $12,000. Okay, and the transaction number here was 8. So we're going to go to our ledger. Find our equipment account, which I believe is near the top. Could be wrong. It is near the top. Okay, so on May 1st, May 1, the description here is to record the purchase of a food truck. Go. This was reference number 9. I'm sorry, 8, I should say. I apologize. And how much was this for? I believe it's for $12,000. Yes. So we're going to debit the account by $12,000. 1, 2, 3. Go. And we've done that. And we paid cash for it. So we're going to go up to cash. And on May 1st, there we go. The description here was to record the purchase of a food truck. Perfect. Reference number 8. and we are crediting the account by $12,000. Go. So that one's done. Okay, so the equipment transaction is completed. I'm going to stop sharing my screen, come back to the chat, and see if you have any questions here. And put a thumbs up in the chat if you were able to transfer that transaction to your ledger. Very good. I'll wait for a few more thumbs up, just making sure everyone's on the same page. Okay, very good. All right, so let's post the last transaction. So I'm sharing my again. There we go. So the last transaction that we're going to have to post to the ledger is the bank loan that we took out for $10,000, and with a reference number of 9. So we're going to go to general ledger. We're going to go to cash because that was our debit. So we're going to May 1. Perfect. To record new bank loan. With transaction number 9. Perfect. And we're debiting the account by $10,000. Okay. Now we're going to go down to find our, oops. See, this is I think what Vanessa was talking about. Somehow I put a 9 in here, delete it, put a 9, and it shows up as a date. How I want to reformat this is I go to the home page, or the home tab, go to this drop-down menu and just reformat it as a general cell. And then we get it as 9. Very cool. All right, let's go down and find our bank loan account. Where are you? Okay, it looks like we don't have one again, so we got to put it in. So we're going to put in bank loan here under our blank account. Okay, so now we've got a bank loan account. Put in the date, May 1. Go. The description is to record a new bank loan. Go. Reference number was 9, and the credit was $10,000. Perfect. So now we've ledgered or posted all of our 9 transactions, or all 9 transactions to the ledger. I'm going to stop sharing my screen and see if you have any questions before we continue with balances. So throw a thumbs up in the chat if you were able to post that transaction to the ledger as well. Very good, very good. Let me show it one more time. Yeah, sure. So I'll show it one more time, and then I'll go to the next step. So we're gonna take the balances of our accounts after I show that one more time. So I'm gonna share my screen. Go. So with that particular transaction, we were debiting cash by $10,000, and we were crediting our new bank loan account for $10,000 as well. So, ledger here, all the way at the top. I inputted the $10,000 debit under my cash account. Okay. Record new bank loan, reference number 9, and we debited it by $1,000. Okay. And then I had to create at the very bottom a new bank loan account. So I typed in bank loan here, typed in the date, similar description, same reference number, and I credited the account by $10,000. Okay. So now what we have to do is a trial balance, and before we do that, we have to take the balances of all our accounts, like we did last week. But now we have some more information here. So what we want to do here is add up all of the debits, all of the credits, and then find the balance for each account. So in this case, I'm going to add up all of my debits. There we go. And I'm going to subtract all of my credits. And you can do this pretty much any way you want. I'm just doing it this way because I find it easier. And then we get a debit balance on our cash of $50,000. Here, there's a question.
Hey Dave, so I'm kind of new with Excel and everything, but is it possible to make an equation in the bottom right cells for both the debit and credit balance, so that every time you have to switch up something in the account or add something in each account, it just automatically calculates it?
That's a good question. Yeah, you could. But what might become a little tricky is that if you include more things, like if you put your equation right here in this cell, and you put information here, this equation won't capture what's being inputted here,
Okay.
right? You're kind of limited by the space uh, in the account itself. What you could do, I suppose.
Like, could you do D minus E or like E minus D, like just column wise? You know what I'm trying to say? It's,
Yeah, so what you could do here, um, down here, is you could hit equals, you type in, I'm not sure if this is going to go well here. So I'm going to just try it out anyway. So you select all of your debit columns. Okay, there we go. Minus, okay, then minus the sum of all of your credit columns. And you should get the same answer. Yeah, so you can do it. The equation's up here. It's just the sum function of the two columns. And how you would keep this um, how you would keep this formula working well is if you needed to add in more information, what you would do is you would right click um, on a row. You would then hit insert, and then you would click entire row, and it'll insert a row, and it'll be inclusive in the formula. Like it'll be included. So whenever you're doing that, you would just whenever you want to add a row, you would just add a row.
right. Perfect. Thank you.
And then, of course, you'd have to be careful because of what column you're putting that equation in, because you wouldn't want to put that equation in here because it would show that your cash had a credit balance. Yeah, good question. So it was $50. I'm just going to put it up here. There we go. $50. That's not a great cash balance, but it's just an example. For our equipment account, we had two debit entries for a final debit balance of $15,500. We want to come down to our food inventory. Okay, so we add up all of our debits. So minus our credit. We have a food inventory balance of $1,430. Coming down to our beverage inventory, there's only one debit entry of $450, so our balance will be $450. Down here again, our food sales, one credit entry of $8,500. So our balance will be a credit balance of $8,500. Our cost of food sold, only one debit entry of $570. So we'll have a $570 balance on the debit side. Prepaid expenses, only one debit entry of $1,500. So we'd have a debit balance of $1,500. So nothing in the depreciation expense yet, nothing in accumulated depreciation, nothing in the interest expense, nothing in interest payable, but we do have, we do have a credit in our accounts payable. We do have a credit entry of $1,000. So we have a credit balance of $1,000 because it's the only entry. Our bank loan here, we have a credit entry of $10,000. So it's only one, so we'll have a credit balance another 10,000. Go, and then we're done. Okay. So what I'm going to do before we continue to post these balances to the trial balances, I'm going to stop sharing my screen and see if you have any questions. Go, go, Ryan. Why is the credit and the cash different? Why is the credit and the cash different in the debit and credit? Right? I don't quite follow the question. Oh, question no. Okay. Do we need to state the food inventory was purchased on credit? Not necessarily. Just to record the. I mean, if you wanted to be that specific, absolutely. But as long as you have to record food inventory or the purchase of food inventory, you're good. So we're good. How did you get 50? Ryan, I added up all of the debit entries, and then I subtracted all of the credit entries. So you got to add up all the debits, and then you got to subtract. You got to add up all the credits, and then you got to subtract them. Then when you do that, you should finally get 50. So put a thumbs up in the chat if you were able to. Oh, Paul has a Paul. Did that answer your question, right? Have your hand up. Awesome. So put a thumbs up in the chat if you were able to take the balances of each of your accounts. I'll wait for a couple more thumbs up. Okay. All right, so now what we're going to do is transfer those account balances from the ledger to the trial balance to make sure we balance. Okay, and if we've done everything correctly, we should balance. Fingers crossed, of course, because mistakes do happen. If not, so I'm going to share my screen again. There we go, window, perfect. So here's our ledger. We've got all our balances. So let's post them. Right. So we have a $50 debit balance in our cash account. So we go to our trial balance. Put $50 in the debit column. There we go. Back to our ledger. We also have a debit balance of $15,500 in our equipment. So go to our trial balance and equipment, wherever it may be, right here. 1,000. Oh, how much was it? 15,500. 15,500. There we go. We continue down the ledger. We have food inventory balance of 1,430. Food inventory 1,430. That. Okay. General ledger, go back, and then our food inventory has a balance of 450. So food, liquor inventory, 450. There we go. Back to our general ledger. We have food sales of 8,500. So food sales is right here. Credit entry of 8,500. There we go. Our ledger, down. Cost of food sold, the debit balance of 570. So cost of food sold, where are you? Debit entry of 570. There we go. Continue down here. Prepaid expenses, we have a debit balance of 1,500. So prepaid expenses, where are you? We'll put it under prepaid rent. I'm just going to change it to prepaid expenses. There we go. And how much was it? It was a credit entry of 1,500. 1,500. There we go. Okay, I'm just going down here. There's nothing in depreciation expense, accumulated depreciation, nothing in our interest expense, nothing in our interest payable. Accounts payable had a credit entry, or credit balance of $1,000. So we'll go to our trial balance. Accounts payable, where are you? Accounts payable here. Credit balance of $1,000. There we go. Perfect. We'll go to our general ledger. We have a bank loan of a credit balance of 10,000. So here, where is it? Bank loan. Might not be here. Okay, so down here we're going to put bank loan. Bank loan. There we go. And it was for 10,000. There we go. So we don't balance. Oh my God. This is a problem. So our credits are more than our debits, right? So let's try and figure this out. Okay, so I'm going to go, first step is I'm going to go back to my ledger, go up to my cash account. That was the first one I dealt with here. So just make sure the balance is correct. Go. Perfect. Here we go. Should be a $50 difference. There is, so our balance is correct here. Go. Debit balance of, yep, that's correct. Okay. And coming down, 1,000, 2,000, yep, that looks about right to me. That's obviously right. Credit, it's right. Correct. Correct. Gosh. So what's the difference here? There we go, minus this. 3,000. Okay, so we didn't have a transaction worth 3,000, so this is probably a compound error. So I'm going to stop sharing because I think there's some comments in the chat. There we go, quite a few. Oh, okay, so you caught it already. Okay, so you're looking at the prepaid expenses. It should be in the debit. It should be. So let's check it out. Sharing my screen. Prepaid expenses, which is right here. There we go. You are correct. Oh, it did bounce. Perfect. There we go. That's interesting, and that's exactly how what is it called? One mistake can kind of throw it off. But what I just saw is that, remember? Okay, so I'm going to put it back. $1,500. So the difference here was 3,000, right? We would have. There's no transaction in our ledger or in our journal that's worth 3,000. But because we've posted it to the wrong column, if that's a mistake that you've made, what we can do is take that amount, divide by 2, because it's compounded by 2, and that's the amount we look for, and that's how you all found it within the prepaid expenses being in the wrong column. So really awesome job, everybody. I'm just going to put that back in the right column. There we go, 1,500. Balance, this is good. All right, so I'm going to stop sharing my screen. Come back to the chat. Yeah, you can just change the column, Vanessa. Absolutely. Yeah. Oh, okay. You're okay. So yeah, you would change it to your prepaid. Yeah, to your prepaid expenses. Either one. For the purposes here, it's just practice, really. So yeah, that's how easy mistakes can happen, right? That was just one little thing that I put in the wrong column, and it threw off my trial balance. Okay, we all found that pretty quick because it was one mistake. Had we made more than one mistake, it would have taken quite a long time to find out where that was, or at least it would have taken more time than we had just gone through. So really good job, and I'm happy everyone caught that. And I hope that your trial balance is balanced in the future. So now, that's good. And put a thumbs up in the chat if you were able to take your trial balance and it balanced after we fixed that issue. Got some good thumbs going. Share file here. Oh, that's huge. So give me 1 sec here. There we go. All right, good. So we got some thumbs up. This is great. So that exercise that we just did, that's really combined like the last couple of weeks worth of material. It's kind of close to the exercise, and it pretty much is the exercise we did last class. Good practice for everybody because that's essentially your assignment number 1 that's due this weekend. But it's also building the foundation for our adjusting entries and our adjusted trial balances, which is what we're going to talk about now. So this week, the content we're covering is doing adjusting entries, adjusting the trial balance, and then creating some informal financial statements using the financial worksheet. Fixing the trial balance is equal to 8, I'm pretty sure it is, yeah, 19,500, Vanessa, absolutely. Dana, good question. It's not all for today's work. We are going to be doing some adjusting entries, posting those to the ledger, and retaking the trial balance. So with that worksheet, don't close it, we're going to be adding to it, okay? So keep it up. And then we're going to be submitting it by tomorrow at the latest, okay? So today, what we're going to be doing is we're going to be talking about step number 5 and 6 in the accounting process, which is adjusting entries, adjusting the trial balance, and then creating some informal financial statements using the financial statement worksheet, which is step number 6. Okay, we're going to be talking about the need and the purpose of adjusting entries. And then we're going to be talking about the main kinds of adjusting entries that you're going to see and that you're going to have to be able to do on a monthly or quarterly basis. Okay. So step number 5 is adjusting the trial balance and the need for adjusting entries. Adjusting entries are essentially transactions that have not necessarily occurred, however, need to be entered into the accounting system so that account balances are reflective of the true balance within the account. Okay, we need to do adjusting entries because of the nature of accrual accounting. Okay, because over time we use some assets, but don't necessarily have a business transaction to show that we've used them. Okay, these entries are typically entered into the adjustment journal on the last day of the accounting period. Okay, and then we do the adjusted trial balance to start creating our financial statements in the financial statement worksheet. Well, we've already kind of talked about this. The need and the purpose of the adjusting entries is to update the trial balance accounts or the general ledger accounts to reflect the proper balance of all of our assets, liabilities, owner's equity, revenues, and expense accounts. There are different kinds of adjusting entries that we may need to do. First, there are prepayments. Okay, we need to adjust our prepaid expenses for the used portion of the expense. For example, in our previous exercise, we posted to the journal the purchase of 3 months worth of prepaid expenses, right? And that was on May 1st. On May 30th or May 31st, how many months of that 3 months have been used? So you purchased 3 months worth of insurance, we'll say. At the end of the month, how many months have you used of that prepaid insurance? What do you think? Yeah, exactly. 1 month. So you purchased 3 months on May 1st. You purchased 3 months worth of insurance. And then on May 31st, 1 month has elapsed. So you've used 1 month worth of that prepaid expense. So we have to adjust our prepaid expense by the expired portion that we've used. There are also various accruals, okay? So these are items that were not entered into the accounting system but were used during the accounting period, okay? So this is things like wages, utilities, expenses that were incurred but they were not paid as of yet or recognized as of yet, okay? There's also the utilization of assets, okay? So it's adjusting the balance of our asset accounts to show that some of those assets have been used. For example, your cost of food sold, you need to do an inventory to figure out what your cost of food sold was, and then adjust your inventory account by that amount of money to show that you don't have that inventory anymore, okay? Another example of the utilization of assets would be depreciation. So as we use our assets, in a lot of cases, they become less useful over time. And as they become less useful, we need to show that the value of that asset is decreasing. So as time progresses, we have to adjust those accounts to show that each asset or depreciable assets are worth less than they originally were. We also have to maybe adjust some unearned revenues. So when value has been given, but when value has been received but not given, okay, or when some of that has been given, has been received. When some of that has been received and some has been given but not all. Okay, and we'll get there. And then you have to provide an allocation for bad debts. Okay, and bad debts. Bad debts are essentially the amount of money that we think we're not going to be able to collect from our customers, right? So we have to allocate a certain percentage of our accounts receivable that we're not going to be able to collect, okay? Vanessa, I have a question regarding to the cost of food sold versus food sales, okay? Do you mean the difference between the two?
Hi, Professor. Sorry about that. I just had a
No.
question just to understand why do we need to note? I just wanted to know what's the differences between the cost of the food sold versus the food sales? Like, why do we need to note that down? That's just one of the questions. Thank you.
Yeah, it's a good question. Well, your cost of food sold is typically the addition or the sum of your beverage cost and your food cost. The difference between your food sales and your food cost or your cost of food sold is you sold a certain amount of food to guests to produce food revenue or food sales, and your cost of goods sold is the amount of inventory that you sold to produce that amount of sales.
So we're removing the cost of the food sold from our food and beverage inventories?
Yes, you are.
Perfect. Thank you.
No problem. So these are the main type of adjusting entries that you can engage in. Some of the big ones that we're going to talk about today are adjusting prepayments. We're going to be talking about the utilization of assets, bad debts, and I think some accruals. Okay. So prepayments. So prepayments are items or expenses that are paid in advance and will benefit more than one accounting period. For example, in our exercise, we purchased 3 months worth of insurance. So this would be considered to be a prepayment. The purpose of adjusting this particular account is to recognize the expense for the period of time by debiting the expired portion of the prepayment so that whatever remains in the account is the unexpired portion of the prepayment. So for example, we bought $1,500 worth of prepaid expenses, okay, for 3 months, okay? So how much is this insurance per month? So we spent $1,500 for 3 months. So what is 1 month worth of insurance costing us? Exactly, $500. So on May 1st, we purchased $1,500 worth of insurance for the next 3 months, which means that the monthly rate of our insurance is $500. Okay, so let's forward to May 31st. We recognize now that a month has passed, right? And we have now used $500 worth of our prepaid insurance. How much is left of what is the unexpired portion, or what is left of our prepayment? Exactly, Vanessa. TG as well. The unexpired portion is $1,000, and we also have to recognize the expense of $500 for the month. So we're really just adjusting the account for the expired portion, which is an expense, and the unexpired portion as well, to show the true balance of this particular account. Right? Good. I'm happy you caught on to that really quick, because sometimes this one's kind of tricky. So here's just a visual example. Okay. So on November 1st, okay, we purchased 2 years worth of 2 years worth of 2 years worth of insurance for $2,400. So we debited our prepaid expenses by $2,400, and then we paid cash, so we credited our cash count by $2,400. Right? So that would be the journal entry here. The adjusting entry here on December 31st, on December 31st, we have to do an adjusting entry. How many months have gone by since we purchased our 2-year insurance? 2 years worth of insurance. Yeah, Paul. Absolutely. 2 months. So we have to find the value of 2 months worth of insurance, so we can A, show the expense, the expense, and the unexpired, and then reflect the unexpired portion of the prepaid expense. So if we take $2,400, we divide it by 24 months, because that's 2 years, right? We get $100, and then we multiply it by 2 months. So the math would look like, because it gets a bit jumbled here on the slide for some reason. So $2,400 for 2 years or 24 months equals $100 per month. But we want to find the cost for 2 months. So we multiply that by 2, that's X, and we get 200. So we would be showing the adjusting entry here would be our insurance expense. We would be debiting it by $200, to Vanessa's point, to show that we've used up $200 worth of, or we've incurred $200 worth of insurance expense over the past 2 months. And then we credit our prepaid expenses to show by $200, to show that we've used up $200 of that prepayment. And then the entry here, or the description for the entry here, could be something to the effect of, to record insurance expired from November 1st to December 31st. Okay. Very good. So, and that would be the adjusting entry for our prepaid expenses. Now, if you're asking me, okay, Dave, how do I know when to do an adjusting entry? Okay. If you have a prepaid expense and time has passed, you have to do an adjusting entry. So to have prepaid expenses means that you will have to do an adjusting entry in the future. It's just the nature of the account itself. Okay. Does anybody have any questions about this particular type of adjusting entry? Or put a thumbs up if that was fairly straightforward. Okay, good. Shall continue here. So this is how your prepayment would look in your general ledger. Okay, you would show that you've made an adjustment for $200 in your insurance expense, and your adjusted balance would be 200 because it's the only entry. You have in your prepaid insurance, you have the previous balance of $2,400, and then you have an adjusting entry for 200. 2,400 minus 200 shows the adjusted balance or the updated balance of your prepaid expense account as 2,200. And that's how it would look in your ledger. It's going to look a little different in our ledger because our ledger looks different. But again, we're going to do an exercise with all of this. So some accrued expenses. We do have to record some accrued expenses, and these are expenses that are incurred, but they're not recorded yet. In a lot of cases, interest over the period of time is incurred, but it isn't charged to us just yet. But because of the matching principle, we have to show that we did have an interest expense during a particular period of time. But before I continue here, how does everyone feel about a quick 10-minute break? Kind of need give my voice a rest. You guys can go grab a beverage or a snack. What do you think? Okay, so we'll take 10 minutes here because I do kind of want to get to a little bit of an exercise here. So it is now 3:01. We'll take a break. Let's be back, we'll say at 3:12. Okay, so we'll give you 11 minutes. So everyone have a good break, and I will see you back here at 3:12. All right, welcome back, everybody. Everyone had a good break. So now we're going to talk about accrued expenses, or expenses that have been incurred but not yet recorded, mainly because we haven't received a statement or some sort of bill from to show that that expense has incurred. So the example we have here is that you have a $10,000 loan. Okay, so it's a 30-day note, which means it's payable within 90 days or 3 months. So because this is what we would consider to be a short-term loan, because it's 90 days and it's due back within one operating year, we would consider this to be a payable. So this would be a note payable. So when we take out the loan on November 1st, the journal transaction would be cash for $100,000, and then we would credit notes payable because it's a short-term liability or a short-term loan, and we would credit that by $100,000. Okay, so let's fast forward to December 31st. So again, like the last example, um, 2 months have passed, okay, and we need to record or adjust the account to show that, or adjust some accounts to recognize an expense that we have not paid yet, but that was incurred over the course of the 2 months. Okay. To Vanessa's question, does the rate change over the years? The interest rates do change based on a lot of things. The Bank of Canada will adjust interest rates based on inflation, deflation, recessions, things like that. For example, when COVID-19 hit, or just after COVID-19 hit, the mortgage rates, which is the interest on a mortgage loan, dropped huge, and the rates are great right now, or they were. The reason for that is because these lenders want you to, they've lowered the interest rates to incentivize you going and getting a mortgage. The Bank of Canada does a very similar thing. If the economy is not doing so well and we're heading into a bit of a recession, the Bank of Canada will lower the lower standard interest rates to incentivize people engaging in the economy. So that's taking out loans, investing in equipment, starting new projects, building new businesses, things like that. So the rate does fluctuate. The interest rate also depends on the financial instrument that we're talking about. For example, right here, it's a 90-day note. Okay, it's got a 12% interest. A longer term loan, over 25 years, would have a lower interest rate. Okay, another example would be your credit card. Your credit card has a 20% interest rate, whereas government bonds have like an interest rate of like, I don't know, it feels like an interest rate of 0.01. And the reason why there are different rates is because of risk. The higher the risk of the instrument, the higher the interest rate. For example, credit cards, super high risk, high interest rate. So they do change, and it depends on kind of what context we're looking at. So absolutely. In this case, we're paying $12% per year for $100,000 loan. So what we want to show in this case, the adjusting entry, is we want to show the expense of 2 months worth of interest, okay, because 2 months have passed. So first we have to calculate how much interest we've incurred, okay. I've put some calculations into the chat here, okay. First, we want to calculate the amount of interest we would pay per year. And to do this, you take the principal of the loan and you multiply it by the annual interest rate. So in this case, you take $100,000 and you multiply it by 12%. Once you do the math, you should get $12,000, right? But that's $12,000 per year, and you want to know how much per month or for 2 months. So you take the interest to understand how much you pay in interest per month. You take the yearly interest amount and divide it by 12 months. That gives you the monthly rate, or the monthly amount of interest. And then, because we're talking about 2 months in this example, you multiply it by 2. And if we do the math, here we get $2,000. So the adjusting entry on December 31st would be, we would debit our interest expense by $2,000 to show that over the course of those 2 months, we've incurred $2,000 worth of interest expense or interest costs. And then we would credit our interest payable by another $2,000 to show that we've incurred this expense, but we have not paid the interest yet. So interest payable. Vanessa, are we calculating the interest of $100,000? Yes. Well, you're calculating the 2 months worth of interest on $100,000. Yes, absolutely. So how does everyone feel about that? Do you want to see the calculation for that $2,000 worth of 2 months interest, or does the math follow pretty straightforward? All right. Maybe put a thumbs up in the chat if you're ready to continue. Okay. Okay. Well, if you do have a question and you didn't want to voice it, the calculations are right here. So even if it's a 90-day loan, the interest is being calculated with the yearly rate. Yes, absolutely. Because we state, typically we state the interest rate on loans as an annual rate, unless it's otherwise specified as an effective monthly rate. But we don't typically do that. You can calculate the effective monthly rate, but it's much easier just to use the annual here. Does that help answer your question, Mary Ellen? Okay. So the loan, how would I break this up? There's three portions. There's three components to any loan, any bank loan. One is the principal. So this is the principal here. There we go. There's the interest rate, which is right here. And then there's the term. Okay, and the term is the amount of, well, the term can apply to a couple different things, but in this scenario, the term is 90 days or 3 months. And that is how many days or months you need to pay back $1,000 worth of money. So you would be, yes, exactly, Marianne, so you'd be paying $3,000 in total. Now, the reason we're calculating the interest using the annual rate is because that's just the simplest way to do it. You can use the monthly rate if you'd like, the monthly effective rate. However, it's always based on the annual rate. So you always use the annual rate to calculate the interest, even though the term is 90 days, we still express the interest rate per year. That is a lot of money to pay off in 3 months, absolutely. So that's why when you're taking a loan, you make sure that A, that you can pay it back within that amount of time, and B, that you're using that for a really good reason. But at the same time, a bank, if the bank didn't think you could pay, if the bank thought you could not pay that back within 90 days, they wouldn't give you the loan. And we're actually going to talk about how that decision is made near the end of the 7 weeks. So it'll be pretty interesting, I think. All right, let's continue here. So you are paying, and that's a good question, so I'm going to go back. So what are you paying back? Yes, technically in total, you are paying $103,000. However, you're paying back $100,000 worth of principal, and you're paying $3,000 back worth of interest. Absolutely. So this is what the adjusting entry would look like. Okay, again, we're debiting the interest expense by $2,000, and then we are crediting interest payable or accrued interest payable. You can use either or by $2,000, and what is it called? The description here of the adjustment would be to accrue 60 days worth of interest on a 90-day note at 12% per year, or the effective monthly rate of 1%. Okay, but again, you don't have to know the effective rate just yet. And then depreciation, yay! Another accrued expense, but also a utilization of assets, technically. Depreciation is the allocation of cost over the course of an asset's useful life. So we're spreading out the cost of an asset, excuse me, over the course of however long it's going to be useful. Okay, and how we calculate depreciation is we take the asset value, okay, we minus the scrap value, or the scrap value is how much money you would receive if you were to scrap it, sell it to a junker, or try and sell it at that point. And then you divide that by its useful life, okay? So in this particular example here, we've purchased furniture that has a useful life of 10 years, and it cost us $60,000. In this case, let's assume that it has a zero scrap value. Okay, in fact, most, unless otherwise stated, most assets at the end of its useful life will have a scrap value of 0. So let's calculate some depreciation here. Okay, so $61,000 was the value of the asset, plus a 0 scrap value, or sorry, minus 0 scrap. I'm going to erase that. So 61,000, which is the value of the cost of the equipment, minus the scrap value, which is 0. And then we divide it by 10 years. So in this case, absolutely. And this is our depreciation for 10 years. So if we do the math here, 61,000 divided by 10 years is $6,100 per year. Okay, but this is, what is it, 2 months, I believe. So we divide by 12, and then we multiply by 2. And of course, their depreciation amount is incorrect. It's actually $1,000, but just run with the idea here. And to Vanessa's comment, the expense over the year, yes, will be $6,100, except that your depreciation expense, the cost, or yeah, $508 per month in a given year, absolutely. However, your depreciation expense is a non-cash expense, which means that you are showing an expense and a cost that is very real. It will show up on your income statement, and it will be deducted from your revenue. However, you have not actually paid out any cash. So the difference between your depreciation expense and every other cost that you'll have is that when you've paid an expense, most other expenses, you've actually paid out cash. With your depreciation expense, it is a cost, but you actually don't pay it in cash. The reason why we show depreciation, there's 2 reasons. One is to show that over the course of an asset's useful life, it is becoming less valuable, or it is losing value by the amount of the depreciation, but also depreciation is an expense. And as we show an expense, it reduces our operating income or our profit. And as it reduces our profit, it also reduces the amount of taxes that we're charged or that we have to pay the government. That's how the government incentivizes investing in new assets, replacing equipment, and things like that. There's a tax break on it, right? So that's why it's there as an expense. So while the figures here are incorrect, and I apologize for that, I don't know why. So if we sell it by the 4th year, it still has some value. Exactly. It will have some value, and that value in the 4th year of a 10-year useful life is what we call its book value. That or what it's worth at that particular point in time, minus those 4 years worth of depreciation. Absolutely. So the journal entry here would be we'd be debiting our furniture expense, our furniture account by $61,000, and we'd be crediting our cash account by $61,000. Oh, I understand why it's $2,000. It's because it's actually 4 months worth of depreciation. So the math here is right, except it's 4 months, not 2. Okay. Excuse me. So over the course of those 4 months, we have to show the accrued expense of depreciation. So here we debit our depreciation expense by $2,000 to show the expense was incurred over that period of time, and we credit accumulated depreciation, comma, furniture. Okay, so this is the amount of accumulated depreciation for the furniture asset. Okay, and your accumulated depreciation is what we call a contra asset account. Okay, so technically it is an asset account, but it behaves like a liability, which is why we are crediting this account, because it behaves like a liability. I believe on the next slide, yeah. And then this is how your accumulated depreciation works or would show up on your balance sheet. Okay, so you recall in September, we purchased $61,000 worth of furniture and equipment. Okay, so on your balance sheet, you'll show the historical cost. And then on December 31st, we calculated our depreciation for the 4 months, and we got $2,000. And that increased our accumulated depreciation account by $2,000. So if we take the original cost of $61,000 and the amount of the accumulated depreciation so far, so we're just subtracting the two, we get the net value or the net book value of our furniture and equipment of $59,000. So what that means is we purchased equipment in September for $61,000, and now that time has passed, our furniture and equipment is only worth $59,000. So we're in doing that adjusting entry, we are recording the expense for income tax purposes, and we're recording the accumulated depreciation for the asset to properly or more properly reflect the true value of our assets. Okay. Can I help answer any questions about depreciation or what we just did there? Okay. All right. And then inventory adjustments, okay? At the end of most accounting cycles or accounting periods, we have to adjust our inventory for the amount of the inventory that we've sold and don't have anymore, okay? Because we have, what is it called? In restaurants or in food service, we have many different kind of supplies or inventories. We have food inventory, we have beverage inventory, and we have operational supplies. we have to adjust those inventories for the amount of the inventory we no longer have and that we've utilized some of it. For example, we've used our food inventory to sell to customers to produce food sales. We've sold some of our beverage inventory to customers to generate beverage sales. And we've used some operational supplies just in the day-to-day ongoings of business. For example, using takeout containers, accidentally breaking plates, using chemicals, things like that. Okay. So typically, you have to do an inventory to figure out the amount of product you don't have anymore. Okay, and you have to adjust it and do some calculations to figure out the used portion. So let's say here on May 1st, we purchased some supplies inventory. We'll call it operational supplies for $300 cash. So we debited our supplies inventory by $300 and credited cash by $300. Let's also say on July 10th, we purchased more office supplies inventory on credit. So we debit the office supplies inventory again, and we credit accounts payable because we didn't use cash. Okay, so how much inventory should we have over that period total? We purchased $300, and then we purchased another $500 worth of inventory. How much inventory did we have at one point altogether? Exactly, Paul. 800. So 500 plus 300. Now let's say you've gone and you've done an inventory. Okay, so you've gone around to look at all your office supplies and what you got, what you don't have, and you valued what you have on hand on October 31st, $200. So you have $200 left worth of office supplies, right? And Vanessa, yes, accounts payable is applied only in the short term, absolutely. But it's also typically the amount of money that you owe people, yeah, within the short term, yeah. So you had $800 worth of supplies, and now you only have $200 worth of supplies. How much money, how do I say this? You had $800 worth of supplies, now you only have two. How much money worth of supplies did you use over this period of time? Exactly, Vanessa. 600. When as well? 600. You had 500. Now you've got 200. You take your what you had, which was 800. You minus 200, which is what you have on hand. The difference is what you don't have anymore, right? So that's 600. So the adjusting entry here would be you would debit the office supplies expense by $600, and you would credit the office supplies inventory by $600 again to show that you don't have that amount of inventory anymore. This adjustment can also be done with your, like I said, your food and your beverage inventory, except when the debit in those entries would not be your food expense, it would be your cost of food sold. And then in the beverage example, it would be, instead of beverage expense, it would be your cost of beverage sold, and you would be debiting those. Okay? And then to that point, we do have a bit of a cost of goods sold calculation. You guys should have seen this in cost controls, but just in case you need a refresher. If you have a beginning inventory, you take your beginning inventory, you add the purchases for the period, and then you subtract the ending inventory. Okay, and then that is the value that you adjust your inventory by. Okay, so let's do a little bit of an example here. Let's say your beginning inventory was $100. Let's say your purchases were 500, and let's say your ending inventory, wow, that's supposed to be ending. Your ending inventory was 200. What is your cost of food sold here? Take your beverage inventory, your beginning inventory, you add your purchases, and then you subtract your ending inventory. Exactly, Nick, $400. So that's how we calculated that was we took the beginning inventory of $100, we added in our purchases, okay, so 600 now, and then we subtract the 200. So 600 minus 200 equals 400. So that is our cost of food sold. Excuse me. If you didn't have a beginning inventory or the question didn't state it, like the previous example, you just take your purchases and subtract the ending inventory. Okay, from the previous example, we purchased $800 worth of supplies, and we had $200 worth of supplies at the end, which gave us a supplies expense of, I think it was $600. Okay, and the adjusting entry here with the cost of food sold, you would debit your cost of food sold by $400, and you would credit your food inventory by the same $400. Okay. So same adjusting entry, just slightly different accounts. Okay. How do we feel about that? Good, bad, confusing, not confusing? Ready for the weekend already? Okay. Put a thumbs up in the chat if you're ready to continue. Okay, we'll wait for a couple more thumbs here. Oh, my nose is getting leaky. All right, we shall continue. All right, so this is how the inventory adjustment would look on your general ledger. Again, we have the adjustment of the on your inventory to show the correct balance, and we have the adjustment here on your in the example of our office supplies. We show the expense of also $600. Ooh, that's really small. So I'm just trying to read that. Okay, so in some cases, we will have unearned revenue. Now, unearned revenue is kind of exactly like it sounds, is revenue that we've collected, but we have not actually earned just yet, right? It's like somebody paying you in advance for you to do something, okay? This happens primarily in hotels. This can happen in catering. Typically, we have to pay out a certain amount. We have to put a deposit down on catering. And in some cases, we need to make an adjustment, right? So here, on October 10th, our hotel has received $10,000 to be used against future reservations. So what some companies will do is they have partnerships with hotel chains. So they'll say, hey, Delta, here's $10,000. All of our associates who come to that travel will use Delta Hotels, and you can deduct their stay from this $10,000, right? So us as Delta Hotels have now what we call unearned revenue. Okay, so we've received revenue, but it's not earned. Unearned revenue is actually a liability. because it's an obligation to do something in the future. Okay. Unearned revenue accounts can be things like customer deposits, or very simply stated as unearned revenue. Okay. So on October 10th, we received $10,000 for future reservations. So our original journal post on October 10th, we would debit cash by $10,000, and we would credit customer deposits or unearned revenue by $10,000. Okay. Let's say fast forward to December 31st, and we've seen that $6,000 has been used by that customer's staff, right? So of the 10,000, they've used $6,000 worth of their prepayment. Okay. In this case, we would debit the customer's deposits or the unearned revenue by $6,000 to decrease the account balance to show that it's been used, and then we would credit room sales, because this is a hotel, room sales. We would credit room sales by $6,000 to show that we actually generated those sales for this particular period of time. Okay, doing this shows the revenue that was generated, $6,000, and it shows that $6,000, and it captures that $6,000 of the unearned revenue or the customer deposits have been used. And to Vanessa's point, that means that the customer deposit account will have a balance of $4,000 because that has yet to be used. Good. All right, let's continue. And then bad debts. Okay, so bad debts is recording or allocating a certain portion of your accounts receivable that you will not be able to collect. Okay, so you can, it creates a cost, right? Whenever people say they're writing off an expense, this would be an example of doing just that. So we're writing off a bad debts expense. We do not need to record the remaining of the customer deposits. Well, you will, Vanessa, eventually you will, because when you post that adjusting entry to your ledger, the balance in your ledger will be for $4,000 or be reflective of the remaining customer deposits. Absolutely, no problem. And how we calculate bad debts, you can do it a couple of different ways. As long as you do it consistently, then it's fine. Usually, we use a percentage to show how much of our accounts receivable we cannot collect, or we anticipate not being able to collect. So in this case, our accounts receivable on the trial balance was $100,000. And it's estimated from previous years of experience that we will not be able to collect 3% of our accounts receivable. So what we would do is we'd take $100,000, multiply it by 3%, okay? And we would get an allocation for the year of bad debts. So in this case, on December 31st, we would debit our bad debts expense by $3,000, and we would credit our allowance for bad debts or doubtful accounts by $3,000. If you recall back to depreciation, the account accumulated depreciation is a contra asset account. Very similar is your allowance for bad debts or doubtful accounts. It is a contra asset. So it reduces the amount of your net receivables. So on your, what is it called? On your balance sheet, it'll show the full value of your accounts receivable, and it will show the value of your allowance for bad debts or doubtful accounts. And if you subtract the two, it gives you your net receivables of, in this case, it's $97,000. So that's what you anticipate being able to collect. What else did I mention here? And then in some cases, and we will talk about this a little later on in the semester, you can do a reversing entry here in the event that this customer paid or somebody paid the $3,000. You could just reverse the entry and pay it down. All right. Before I continue to the adjusted trial balance, does anybody have any questions about bad debts? No? All right. So once we've done all of our adjusting entries, okay, we post them in the journal, we then record them in the ledger, and then we post the updated balances or the current balances of the accounts in the ledger to the trial balance. Okay, we also post the adjustments to the ledger accounts to the worksheet, which is what I'm going to show you in just a second. Instead of going through all of this, I am just going to show you what it looks like. Here we go. So this is the financial statement worksheet. This should seem really familiar to you because we've been using it for the last couple weeks. Okay, so up until this point, we've gotten here to the initial trial balance, right? Once we've done posted our adjusting entries to the general journal and the general ledger, we post the individual changes of those adjustments to the debit and credit columns of the adjustment columns, okay? And then we post the adjusted account balances to the adjusted trial balance here, okay? Now we're doing this for two reasons, okay? Because when you're doing this, it might feel like you're taking two steps to do one thing, and I can kind of appreciate that. We do this for two reasons. One is to show that in the adjusted trial balance that things have been adjusted and that your debits equal your credits, okay? But in the event that they don't balance, you can immediately go to look at your adjustments, because the difference between the first trial balance and the second trial balance is the amount of these adjustments. So all you have to do is some quick addition and subtraction to check your math, and you should be able to find a mistake if it doesn't balance very quickly. Okay, and then from our adjusted trial balance, we can transfer the balances of all of our accounts to either the respective placement on the income statement or the balance sheet columns. And this is where we start to create informal financial statements. Okay, yeah, and then after that, we do what we're going to talk about next week, which is the final step. Next class, which is the final step in the accounting cycle, which is closing the books or closing our accounts, which is it's actually pretty easy. There's only 3 steps. Okay, so this is the financial statement worksheet. Okay, I'm just going to erase this for a second. There we go. Can I repeat what, Ryan? About the income statement and the balance sheet? About the income statement, yeah. So once we've created our once we've created our adjusted trial balance, we have all of the ending balances for all of our accounts. It's those accounts that create our income statement and our balance sheet. All we have to do is transfer the balances to the appropriate columns of either the balance sheet or the income statement, and we're starting to actually create income our financial statements. They're not audited, they're not in good form, but they are informal financial statements. Does that help, Ryan? Awesome. So I'm just going to erase this one more time here. There we go. Yes, Ryan? Ouch. Oh, yeah, absolutely, Ryan. We're not going to have time today to go through some of the adjusting entries and stuff like that, but we're gonna complete the entire thing at the beginning of next class. Absolutely. And worth noting to you good people is your assignment number 1 is essentially getting to this point. Okay. Assignment number 2 is doing the rest. Okay. So in assignment number 2, you're going to have to do adjusting entries. You're going to have to do an adjusted trial balance and start to create some informal statements. Yes, the worksheet that you've been completing today, yes, you will hand it in, and then save it because we're going to continue with it on Thursday. Okay. Continuing here, I just want to show you a filled out version. There we go. Here's typically, here's what a filled out version will look like. Okay, you have your first trial balance here. You have the individual adjustments from your adjusting entries. Okay. You will then have your adjusted trial balance. And then you can create your financial statements by moving the appropriate balance to the column. For example, right here is cash, which is a balance sheet account. The ending balance on it was $100 debit, and it was transferred to the debit column of the balance sheet column. But we'll get there. We're gonna do an exercise of this. Okay. Yeah. Let's see. What's here? Don't worry about that. Okay, so maybe we'll conclude there because we always don't have enough time to do some adjusting entries or do an exercise of them. So what we're going to do next class on Thursday is we're going to continue with the worksheet that we were working on today. We're going to do some adjusting entries. We're going to log them into our journal. We're going to log them into our ledger. We're going to log them into the adjustments side of our trial balance, or sorry, of the worksheet. We're then going to take the updated balances on our ledger, create our updated or adjusted trial balance, and then post that information to either our income statement or our balance sheet. And then for the remainder of class, we're going to be talking about closing entries. It probably won't take too long because it's only 3 steps, or 3 entries, if you will. Okay. Ryan, can you remind us what is due by the end of this week one more time, please? Yes. So by the end of this week, on Sunday, your assignment number 1 is due. Assignment number 1 is due, and what is it called? Please submit the worksheet that we were working on today to the Class 5 Dropbox on Blackboard. Please also save it to your computer so we can continue to work on it or progress through it on Thursday. Okay? How's that sound, everybody? Does that make sense? Throw a thumbs up in the chat if you're on board. All right, good. I mean, I know it's a lot of, it's quite a bit of practice, but I think it's good. You mean the one worksheet that we did today during class? Yes, absolutely, I do. Yes. Awesome. All right, good people. Everybody have a good rest of your day. Okay, good class, good practice. You all did very well. And we'll talk to everybody on Thursday. Please email me if you have any questions whatsoever. Have a great day, everybody. And a good rest of your week. Actually, I'll see you on Thursday.